War has officially been declared, missiles are flying, oil routes are under threat, and while most people are just waking up to the headlines, silver is sitting at $95, PAXG just spiked to 5,600, and physical gold in China is trading at 5,560 per ounce, a $282 premium over Western paper prices. That is not normal. That is not random. That is the market reacting in real time to something bigger than a news cycle. Before we go deeper, if you value calm, clear breakdowns during chaotic moments, hit like and subscribe right now. On Past and Profit, we focus on structure, not panic. We read the signals, while others react to headlines. If you want to stay ahead instead of catching up, you're in the right place. Slow this down and connect the dots. War changes everything, not just politically, financially, psychologically, structurally. The moment combat operations begin, markets stop pricing possibilities and start pricing consequences. That shift is critical. Silver at 95 is not just a number, it's a stress gauge. When geopolitical risk rises sharply, hard assets tend to move together. Oil climbs on supply fear, gold rises on safe haven demand. Silver moves because it sits between monetary metal and industrial metal. It reacts to both fear and supply tension at the same time. PAXG, the token backed by physical gold, surged to 5,600 overnight. That puts it near its all-time high. Meanwhile, physical gold quoted in China is trading at 5,560 per ounce. Western spot is roughly $282 lower. That premium is massive. In the world's largest physical gold markets, buyers are willing to pay nearly $300 more per ounce than what Western paper markets are quoting. That is not a small difference. That is a structural divergence. When physical markets and paper markets disconnect, it usually means one of two things. Either paper prices will catch up quickly, or physical premiums will compress if panic fades. But the gap itself is the signal. It tells you demand is urgent somewhere. Silver trading at 95 during a declared military escalation is not coincidence. Industrial users still need silver. Solar manufacturers don't pause production because of geopolitics. Electronics demand doesn't vanish overnight. At the same time, investors looking for protection rotate toward tangible assets. And here's something most people don't notice until it's too late. Before war is officially declared, markets often start positioning quietly. Lease rates rise, open interest shifts, premiums widen. Then the headline hits, and price reacts violently. By the time confirmation arrives, informed money is already positioned. Oil shipments are being questioned. Strategic routes are under scrutiny. Airspace closures ripple across regions. That uncertainty feeds directly into inflation expectations. And inflation expectations feed directly into gold and silver demand. But here's the twist I want you to really think about around this point in the video. Silver at 95 and gold near 5,600 are not just reactions to missiles. They are reactions to trust. War shakes confidence in stability, confidence in currency, confidence in leadership. When confidence shakes, hard assets absorb that fear. The $282 premium in China is especially important. It tells you physical buyers are not waiting for Western futures traders to decide what price should be. They are paying up for certainty. They want delivery, they want metal. And when buyers are willing to pay that much extra for physical over paper, that suggests concern about availability or settlement risk. Markets can overreact in the first wave of crisis. Futures can gap up when they reopen, then retrace. Banks and large institutions sometimes step in with aggressive selling during thin liquidity. If diplomatic efforts emerge quickly, premiums can compress, volatility can cool, but the structural signals are difficult to ignore. Silver at 95 is only $5 away from triple digits. 100 is psychological. Once a metal crosses 100, the conversation changes. Media shifts tone, retail attention spikes. Institutional reallocation discussions intensify. And if gold is holding near 5,600 in tokenized and Asian physical markets while Western paper lags, that gap will force a reconciliation. Either Western prices move higher, or Eastern premiums shrink. Markets don't tolerate divergence forever. Another important layer is cross-asset comparison. Bitcoin pulled back sharply during the first shock of escalation. That tells you something about how investors perceive risk. When digital assets drop while physical-backed gold tokens surge, it shows what investors prioritize during immediate uncertainty. Now, imagine this environment sustained for days, not hours. Continued airstrikes, ongoing retaliation, oil volatility, shipping disruptions. That feeds directly into energy costs. Energy costs influence everything from transportation to manufacturing. Silver, as an industrial metal, becomes even more sensitive in that scenario. And let's not forget central banks. Many have been accumulating gold steadily over the past few years. That long-term buying doesn't stop because futures traders hesitate. If anything, geopolitical fragmentation increases the desire to diversify reserves. Now here's the key question for the next 48 hours. When Western futures markets reopen, where do they gap? If they open closer to where PXG and Chinese physical gold traded overnight, you're looking at a sharp upward adjustment. If they open lower, but physical premiums remain high, the tension builds again. Watch whether silver can hold above 95 on strong volume. Watch whether gold sustains above 5,500 in multiple markets. Watch whether the $282 premium narrows or expands. Because these are not just prices, they are stress indicators. On past and profit, the goal is not to predict every tick. It's to understand structure, so you're not emotionally whipsawed by headlines. Right now, the structure shows this. Silver elevated at 95, gold near all-time highs in alternative markets, massive physical premiums in Asia, and geopolitical escalation with unclear duration. That combination, if silver pulls back sharply after a gap up, that doesn't invalidate the structural thesis. If gold consolidates below $500-600 briefly, that doesn't erase physical demand. Markets breathe, they expand and contract. The mistake most investors make is reacting emotionally to the first move instead of observing the follow-through. Ask yourself, if war continues and energy markets remain stressed, what happens to inflation expectations? What happens to real yields? What happens to currency confidence? And how do metals historically respond to those conditions? History doesn't repeat perfectly, but patterns rhyme. Gold at $5,560, physical in China with a $282 premium, is not just panic buying. It's a statement about perceived value under pressure. And PAXG near 5,600 shows that even on crypto rails, investors are choosing physical-backed security when fear spikes. These signals together tell a story. Now, I want to hear your perspective. Do you think Western paper prices catch up to Asian physical levels? Or do you believe premiums compress if tensions ease? Drop your thoughts in the comments. Real analysis only, no hype. And if this breakdown helped you see the bigger picture more clearly, share this video with someone who follows markets but doesn't track physical premiums. The more informed voices in this space, the stronger the conversation becomes. War changes landscapes quickly, markets adjust even faster. Silver at 95, PXG at 5,600, physical China gold at 5,560 with a 282 premium. Stay calm, stay logical, and stay focused on structure. I'll see you in the next one on Past and Profit.